Everything Money. I'm your host, Ray Ross. This is episode 2. We're going to be talking about budget and the different types of budget. Now, a budget definition is simply an itemized summary of planned expenses for a given period, along with the estimated income for that period. An example of a budget is how much a family spends on all expenses in a month. So we have to understand those different type of budgets out there, and I'm gonna go over the 4 main types that I've known to help people work through their finances. Now, when people think budget, we think of low income, we think of impoverished, we think of being cheap, we think of being frugal, but even the richest of the rich have a budget. So we're going to move right into the different types of budgets. First, we have the survival budget. It's the budget that people need just to survive month to month. Savings and debt are secondary at this point because what you have available is whatever is in your purse or in your wallet, and some tools that can actually help you create this budget and follow along could just be your everyday paper and pen, okay? Your paper and pencil, because it's fast, it's cheap, and it's simple, okay? You write down how much you make after taxes. Then you write down all your bills. And then you have to start assigning money to those bills. Now, a survival budget is basically saying, after I pay my bills, I have no wiggle room. I have no residual income. I have no leftovers to do anything else. So that is your survival budget. And it's very, very basic. You understand that a lot of people are living paycheck to paycheck, but a lot of that money may be going to debt, and they also save. But they believe they're living paycheck to paycheck. Now, people who are truly living paycheck to paycheck, they don't have the money to save, and they don't have the money to pay down their debt. And unfortunately, those are the ones who probably hide in their car so they don't get repossessed, or don't even have a car, who's loaning money or all sorts of things, food, clothes, etc., because they just have enough money to pay their bills. So we absolutely have to understand the survival budget is making enough money or having enough income to come in just to cover all your expenses. And of course, this includes food as well. But we're talking about those secondary things like debt and savings. Some of you are saying, well, savings and debt is not secondary. They are absolutely secondary when it comes to your survival. Do you need a roof over your head? Most people will say yes. Do you need food and water? Most people will say yes to survive and live. Is savings a life-threatening or must-do thing to survive and live? No, not at all. Are the debt collectors going to call, change your number, hang up on them, and block them? That's what people do, folks. Or they sit on the phone and argue with them because they don't have the money to pay debt collectors and anything else. So we have to understand this first budget is all about survival, okay? Survival. If you are a wild animal in the wild, you're doing exactly what you need to do to survive that day, and then you're going to do the same exact thing in different ways the next day. But the point is, you're trying to survive. The second budget we're going to go over is called the debt-free budget. Debt-free budget. Now, the debt-free budget is where you assert more control over your finances, okay? Now we're talking about you have some wiggle room. You no longer worry about how to get to the next paycheck, and you start making plans for the future. The focus to get out of or avoid debt by any means necessary by spending less than you make. Let's talk about spending less than you make. I did a video on YouTube. If you're not familiar with me, my name on YouTube is Ross World, and my channel is My Money Makes Money. And I did a video talking about live below your means. And what that simply is saying is whatever you make monthly, live below that amount. So if you're making $5,000 a month, if it's possible, live at $3,000 a month. Now, of course, we can take this yearly. If you're making $70,000, hopefully you can live at $50,000. That gives you so much ammunition to do different things in your finances. We're talking about getting out of debt. We're talking about savings. We're talking about investing, whether it be real estate REITs, 401ks, either your IRAs, your traditional, your Roth, you have drips, you have annuities. There's so many avenues to make money. And that's why most rich people who build their empire from the ground up, they will continue to be rich because they do things to keep themselves rich, and they invest and save, and literally most of them don't have any debt. Now, if they do have debt, it's mostly tied up into the business, and they will sell the debt and the business and then move on and be even richer and buy more businesses. But let's stay focused with the debt-free budget. So the debt-free budget is the focus is to get out of or avoid debt. Now, budgeting here means setting a maximum amount that you want to spend that month on each of those categories. Over time, you ratchet down that amount, you spend less, and you direct the extra money into paying down debt or building up your savings. But when we're talking about debt-free budgeting, you got to pay down that debt in order to start savings, because we understand it's a contradiction. They counteract each other, because if you're saying, well, I'm saving this amount of money a month, but then you tell me you have a certain amount of debt, then I'm really asking, well, how much money do you really have? Because if you owe somebody money, the money you have in savings, is that truly yours? No, not necessarily. That's not the way I look at it. Because if I owe my buddy $50, and I gave this analogy before, it's kind of like if I owe my buddy $50 and we walk into a store, let's say we walked into Best Buy, and I'm looking for a new micro SD card or SD card from one of my cameras or my cell phone. And I'm up here looking at things, and I go to the cash register, and I'm about to buy something, with money, with my card, whatever. And he's like, hey, don't you owe me $50? Because it's almost like an insult when you owe somebody some money, but you're saving money or you have money and you don't pay them that money. Now, some of you say, well, that's not the same thing. And essentially, it really is. It really is. Literally, it really is. Because when you bought that car, when you bought that boat, when you bought that bike, when you bought that house, you didn't have the money to pay that house totally off. Now, if you did, I wish that you go ahead and pay so you're not paying someone interest. But if people have enough money to pay the house off, they usually do. So they're not paying interest on a loan to somebody else and making them rich. So now you have all this money in savings, but you still owe people this money, and you're thinking, well, my savings is gaining interest. And it really isn't, because the interest on your loan is much higher than the interest on your savings. I guarantee you that. And it's still compounding regardless of how you look at it. Just look at your credit card loans. Your fee gets bigger as the amount that you're spending gets larger. So if you're at $100 and they say, okay, well, for $100 you're paying $5 for your monthly fee, then that 10 times, now you're at $1,000. Now your fee, instead of $1, is like $100 you have to pay every month. So you have to look at it like that. It works against you. So pay down your debt. And there's many different ways you can actually handle this. You may be surprised how big a difference you can make simply by tracking just 2 or 3 expenses, the main ones. And let's talk about credit card debt. If we could pay down our credit card debt, cut them off, and then we'll just probably have to worry about a car or bike or something similar to that. We're not going to really get into houses. That's a different dynamic. That's a different area, because in some cases, when you're building that equity, it can counteract that debt over the course of time. And of course, if you're in the market about to sell your house. But see, some people use the old school method, and it still works today. It's called the envelope system, where every bill has an envelope, and you put that money, as soon as you get paid, you put that money in the envelope, and that is where that money goes. Now, of course, today, not too many people are taking out cash. Nonetheless, you can still write those bills on envelopes and assign it and then pay it off that way, whatever that amount is. And that envelope system can be really extensive, because guess what? I always talk about pay your vacation in cash. So label an envelope vacation, label an envelope new TV or LED TV, whatever you want to buy, label the envelope and then start allocating money into that every month. But don't forget the name of this budget, debt-free budget, okay? We can't do that until we clear, cut, zero out our debt. So hopefully we can understand that. And here are some tools that actually help you guys. Now, of course, throughout this podcast, paper and pen is king, meaning that it's free. You can do it yourself. But there are some other applications and software to help you along the way. Now, you're going to hear me keep saying the same one over and over again as my number one. Now, unfortunately, this one actually costs some money. I think it costs around $7 a month. It's called YNAB. And if you can reference my YouTube channel again, I actually did a video on budgeting, and I have a link in the description for YNAB. That's You Need a Budget app, okay? You Need a Budget app. They have a really cool interface that you can go through, and it actually has, I think, over a 4-star rating. It's been saving and helping people budget their money and get out of debt. Now, this one is well known, Mint. Mint is a free application. It links all your banks, all your information, some investment accounts, etc. So you just do a quick Google search and you can look up Mint. You also have Quicken. Now, Quicken has some options for free, but some of their services, it does cost money. And then last but not least, if you don't want to do the paper and pen, you can do Google Docs, okay? They have an Excel spreadsheet, and you can just jot things down and do it the old-fashioned way, line by line, item by item. Thirdly, we have the financial freedom budget. That is the financial freedom budget. When you're planning for the longer term, you can develop a financial freedom budget. You're able to save a significant portion of your income, perhaps into a 401k, IRA, or taxable account, or just all three. Now, in the financial freedom budget, you pay yourself first, okay, because you are financially free. Now, the second one was debt-free budget, but now you are financially free. You're just pretty in the middle of the field somewhere. Just close your eyes and picture yourself in the most beautiful place at the most beautiful temperature and the most beautiful scenery, and the air is nice and light and thin and soft in your lungs, and you're just breathing it in because you are just free from owing anybody anything. Financially free. That means you set aside a certain amount of your income. Now, when we're talking about paying yourself first, that means you set aside a certain amount of your income, whether it's 10% or 50%, and then spend sensibly whatever is left. The easiest and most effective way to do this is to automate your finances. For example, pay into a 401k straight out of your paycheck, right? You don't even see the money. It comes right out of your paycheck. It goes right into your 401k. Or you can set up automatic transfer into taxable accounts. This is one of my favorite things. I kind of do everything automatic, whether it pay bills, go into my investments accounts, whether it be stash with the auto stash, Robinhood. I do all these things so I don't see the money. And the money that I have, that could be some money that I can go buy some little trinkets, some little gadgets, things of that nature. And then sometimes that takes money and sometimes that takes time, because after I pay myself and after I pay my bills and I put money into my investment accounts, the money I have left over is kind of like, maybe I go out and have a drink or two and, pat myself on the back. But it takes time for me to save that money over the course of time in order to buy some of the items that I need, because I just can't put $1,000 on something, or put $300 on something. Maybe I only have $200 left after I do all my investments and bills and savings. So hopefully you understand what I'm getting at when I'm going over the financial freedom budget. If you're able to spend and save appropriately, achieving financial freedom is highly a desirable goal. Financial freedom means achieving a level of financial independency where you have choices for how you live your life. Now, for example, you can choose to continue working, take a few months off, you can travel, or try a different career altogether. That is what we call financial freedom. See, here's the thing, guys. You go out there and you hate your job, you hate what you're doing. You're like, man, I just want to travel, I just want to do this. When you're financially free, you can stop, drop, and roll right into another job, or you can stop altogether and you can go travel for a couple of months, or you can do all of them. Now, there are some apps out there that I've looked into. Now, of course, I love YNAB, You Need a Budget. I'm not a sponsor, I'm not affiliated with them, but they do have a great interface and it's easy to use. Another app, this one is actually created by Ramsey. It's called the Every Dollar app. I've used it, it's effective. Again, it's a simple interface and it is free. There are some portions of this app that does cost you a little bit of money. Mint as well, and Google Docs. So these tools are here to help you, like Every Dollar, Mint, YNAB, and Google Docs. Last but not least, this is the fourth budget, guys. Last but not least, the planning budget. This is also called the retirement budget. Ultimately, you want to know whether you'll be able to afford to stop working. See, we're thinking about 59 and a half, we're thinking about 60, we're thinking about 65, and you're like, how do I exponentially grow my money in order to retire at 59 and a half, which I can start pulling money out my 401k, my IRAs, and not be penalized by taxes? Now if you got the traditional IRA, then you're going to get taxed when you take your money out unless you opt in for Roth initially, which I've done. I just rather be taxed head on so I know exactly how much money I have in the bank. But nonetheless, guys, you want to know when you will be able to afford to stop working. You can look at this at any age because you need to look at it far out. Right now, if you got 20 years from retirement, you can still retire in 20 years, even if you started right now. But you have to do some aggressive saving, some aggressive investments, and you also have to sacrifice in your everyday life, which is fine because guess what? You want that money to be ready, available at an amount that is going to sustain your life when you're not working anymore, because you're not going to have any cash coming in. You're just going to have cash on hand. Now, you'll have dividends. You might have some growth in your investments account. You'll have some interest in your savings accounts, but you're not making any money as far as having a job or career, or maybe you was an entrepreneur and you're no longer working. So you really have to do some aggressive savings. But can it be done in 20 years? Yes, it can. Now, by doing this, you have to estimate how much it costs per month to live your life that you want. You have to estimate this all the way into your years. Then comparing it against your expected income, such as from investments or Social Security. Now, hopefully, Social Security is still around when I'm at the age where I can draw from it, as well as my investments, my savings, etc. It's knowing you have the means to do what you want because you're in control of your finances. Thus, the retirement budget, because we already passed the financial free, but now we're really getting into retirement. We're planning that budget. See, I found that the best way to do this is to go back to the types of categories you may have used in the debt-free budget. By this time, at a much higher level, expenses fall into two buckets. And with that debt-free budget, we went into what? Getting rid of debt, into savings. So that's something to really look at. The two buckets I'm referring to are fixed expenses and discretionary spending. Now, fixed expenses or monthly bills, these are categories that might include property, real estate, insurance, homeowners, health, your life, car, utilities such as gas, electric, garbage, water, internet, etc. And for your discretionary spending, categories might include eating out, clothes, entertainment, travel, maintenance, home and car, groceries. And of course, you can argue some of these amounts with yourself and lower them or higher them, but hopefully you're thinking about lowering them so we can free up more cash to do other things with. Now, in the planning budget, aka retirement budget, you planned up a model of your expenses using these categories. You're not tracking every penny, but you are scanning your monthly bills for areas you can improve on. These can be either in the fixed or discretionary buckets. For example, if your cable bill looks high, talking to your provider about a lower rate or switching to a different provider or just getting rid of it altogether will free up a lot of money. And that's just an example. And of course, some of the tools that you can use for the planning budget is YNAB, you need a budget, Mint, Google Spreadsheet, and of course, the old famous pen and paper. And at the end of the day, the goal is to get comfortable with your rate of expenditures such that you could cover it comfortably with your available assets. And that's basically saying the money that you have, you can afford the assets that you have. Now, when people talk about assets, I also like to throw in liabilities. An asset, in my opinion, is something that makes you money. A liability is something that costs you money. So some people may look at their house as an asset. Well, I asked the question, what are you using your house for? Are you renting it out? Are you renting the rooms? Is it making you money? If your house is not making you money, then it's a liability. And then someone may argue, well, it's building equity, so essentially it is. I say, well, no, you still owe the bank money and you're paying interest. So it's a liability, it's money going out. not money coming in. It's kind of like you want to count money that you don't have on hand because you're like, oh, my house is worth $500,000. Do you know if your house is going to be worth $500,000 when you sell it? Do you know if the market for sellers is going to be cold? So we have to look at those things. So initially, your house is a liability, just like your car. If you're not doing Uber, Lyft, or Wings, or something like that, or a taxi, then your car is a liability if you still have a loan on it, even if you're doing some of those things. Because if you're not bringing in more cash than your insurance, your maintenance, and your monthly bill for your car, then your car is a liability because it's costing you more than you're making from it. Hopefully that's ringing a bell in someone's head. Now, if your car is paid off and your insurance for it is low and you're making more money with those three car services, Uber, Lyft, and Wings, then your car is an asset. Okay? Now, for all of these budgets that I gave, I'll just give you these applications again, just in case you didn't hear the other 4 or 5 times that I mentioned them. Now, You Need a Budget is a dedicated budgeting tool, okay? It's going to do everything for your budget. It costs $7 a month, somewhere around there. Don't quote me too harshly on that. Last time I looked at it, it was $7 a month. And I think they give you around 34 days free, so a month, okay? A month. They give you a month for free. So you can check it out, try it out, see if it works for you. Make sure on your calendar, on your phone, somewhere, if you don't like that app, you always put a day before the deadline. You call in or you email, however you counsel it. That way you're not getting charged. That's just the thing that I always do. I do a lot of things on trial to gain that information and give it out to the people. But I make sure I throw it on my Google Calendar. That way it reminds me a day prior. I call in and I counsel it. Now, when we talk about Mint, we understand that Mint is a financial dashboard app. You have the web page and you also have an app. And like I said before, you can connect your bank and other investment accounts from it, and Mint is free. Then we have Quicken. Quicken has an app and they also have a desktop application. Some of it is free and some of it will cost you some money. So if you want to save some money, you can use Quicken, but steer away from the paid portion. And you have your Google spreadsheet. You have every dollar by day Ramsey, and you have your paper and pen. That is the cheaper method of them all. All right, for our last and final topic, we're going to go over what they call the fiduciary rule. Now, I'm getting this information from investopedia.com. That's investopedia.com. And we're talking about the fiduciary rule. We're going to go over what they call the history of it. And the reason why I worded it that way, because I'm familiar with fiduciary rules and fiduciaries that handle people's finances, but there is also a history out there that they supposed to follow these guidelines. Now, the fiduciary rule expanded the investment advice and the definition under the Employee Retirement Income Security Act of 1974. Now, they automatically elevated all financial professionals who work with retirement plans or provide retirement planning advice to the level of a fiduciary, bound legally and ethically to meet the standards of that status. While the new rules were likely to have and had at least some impact on all financial advisors, it was expected that those who work on commission, such as brokers and insurance agents, will be impacted the most. Now, if you're not familiar with the term fiduciary rule or people who call themselves fiduciaries, basically what they're saying is that they have your best interest at heart, not themselves. Old practices of financial advisors, brokers, and those sort of people, they looked out for their company, they looked out for themselves. Now, you will make some money, but not as much if you went to a fiduciary who looked out for your best interest and who grew your money exponentially, because he would probably not be making the most money if he was a regular financial advisor or a broker of some sort, an investment broker. Fiduciaries came into rule to help the person who's looking out for retirement, who's planning for retirement, who's looking out for investments, looking out for your best interests and not themselves or their company. I don't want to drill that home too much, but I just want you to be aware of fiduciaries and the fiduciary rule and what they actually stand for. Now, supposedly, they're more trustworthy than your everyday people, and some may not have the label. That doesn't mean that if they're not fiduciaries, that they're not trustworthy and not doing best by you. It's just that it's kind of like the icing on the cake, so to speak, in the financial world. And even with that, I'll just say we're all people, and just because you have a title doesn't mean you live up to it. Okay, everyone, that's all I have for this segment of Everything Money. Tune in for the next show next week. We'll be discussing robo-advisors. Robo-advisors like Stash, Acorns, Wealthfront, Robinhood, Betterment, and M1 Finance. So tune in for next week so you can get the information to make your life a lot better than what it already is. This is Everything Money, where we break down complicated financial information and we give it to the people financially free in a common sense way. This is your host, Ross World, aka Ray Ross. I'm out.